Hello, everyone. Thank you for joining me to discuss insurance, what you need and what you don't. My name is Lisa Mahoney, and I'm an accredited financial counselor to help you make sense of personal finance. Let's get started. This presentation, live streamed, or on demand, is for educational purposes only and does not constitute financial, legal, or tax advice. The concepts and strategies shared are intended to inform and empower, but may not be suitable for your specific circumstances. Consult with a team of qualified financial professionals, including but not limited to registered investment advisors, accredited financial counselors, tax professionals, and attorneys who can provide personalized advice tailored to your unique needs. Any references to specific companies, products, or services are for illustrative purposes only and do not constitute endorsements. Investment involves risk, and examples presented are not a warranty of results. By participating in or viewing this content, you agree to assume full responsibility for your financial decisions and outcomes based on the information provided. Let's talk about insurance. Insurance is what you get to transfer financial risk from you as the consumer to an insurance company. It protects your savings from catastrophic expenses. To find the best insurance, you should determine what you need and compare costs across several insurance companies. Instead of contacting individual companies to get individual quotes, use website aggregators to search among hundreds or thousands of companies. Competition is one way to drive down costs. We're going to discuss 9 types of insurance you can consider getting at a minimum, 3 of which you may be able to drop in retirement. The 9 types we will cover include health, auto, homeowners or renters, umbrella policy, identity theft protection and restoration, long-term care, term life insurance, long-term disability, and professional liability insurance. The first is health insurance, and no one should skip on this if they don't have to. Medical debt is the #1 cause of bankruptcy in the U.S., even for those who have health insurance. There are 5 terms to understand about health insurance. First, the premium is the amount you pay for coverage through payroll deduction. It comes out of your paycheck. The copay is a flat rate you pay for products and services, such as prescriptions, primary care, and specialist visits. The deductible is what you pay each calendar year before your plan pays a large portion. The coinsurance is the large portion the insurance company pays as a percentage. Check your health brochure to see what percentage you each pay. It could be that your insurance company pays 80% while you pay 20%, or they may pay as much as 95% and you pay 5%. There is an out-of-pocket maximum you may pay each calendar year that can be thousands or tens of thousands of dollars. There are several types of insurance, and I will only discuss 3 types. The first is the most common, where you choose a preferred provider organization or PPO, and it means your providers are in-network. You can see whomever you want, but sometimes you may have no choice if some providers or facilities for a procedure are out of network or non-PPO. An example of this type of insurance is Blue Cross Blue Shield. Another type is a health maintenance organization, or HMO, where care is coordinated in a region and within a facility. You will need to go to the primary to get a referral to a specialist. An example of this is Kaiser Permanente. The third type is a high deductible health plan, or HDHP. The premiums are extremely low, and you take more risk by having a higher deductible. I recommend getting this type of insurance plan if you have a 3 to 6 month emergency fund to afford the deductible. Let's briefly compare the different tax-favored accounts for qualified health expenses. The one that most people are familiar with is the Healthcare Flexible Spending Account, or FSA. You decide how much to contribute pre-tax, and payroll deducts a portion each paycheck throughout the year. You use it for reimbursement of qualified health expenses and is use or lose, meaning whatever you don't use expires. The FSA is used with PPOs and HMOs. You can combine a limited purpose FSA for dental and vision expenses only with a health savings account or HSA. The HSA can only be used with a high deductible health plan. It has a triple tax advantage. You can contribute pre-tax dollars, it grows tax-free, and it stays tax-free when you use it for qualified health expenses. The HSA is deposited to a bank account in your name. The funds carry over year to year, and you can invest a large portion over decades, as you see in the lower right-hand corner of the slide. You can submit expenses whenever you want since it is not use or lose. The account is yours to keep when you switch plans or employers. The last option is the Health Reimbursement Arrangement, or HRA. It's opened if you don't qualify to have an HSA. You don't contribute to it, and unused funds roll over each year. You lose the HRA when you switch employers. Let's talk about bundling home and auto along with an umbrella policy. It's a good idea to shop around to bundle home and auto coverage as well as the umbrella policy. And if you have an emergency fund, you can increase your deductible to lower the premium cost. Convenience costs you, so you can also lower your premium costs by paying the policy in full instead of installments. To better understand why an umbrella policy is important, let's discuss auto insurance. Auto insurance generally has three parts of coverage that include bodily injury per person and per accident, as well as property damage. For instance, let's assume your policy has $100,000 of bodily injury per person, $300,000 of bodily injury per accident, and $100,000 of property damage. If there's an accident and you're responsible for one passenger with $199,000 in hospital bills, you would pay out of pocket for the $99,000 because the per person bodily injury limit of $100,000 was reached. To avoid this catastrophic expense, you can get a $1 million umbrella policy for about $300 a year to cover for that specific liability. It also provides coverage for your home as well. Identity theft protection and restoration is a relatively new policy that people are considering. Several years ago, we did not have to worry about our passwords and protected information being compromised. Now we know that data compromises are common in the retail, healthcare, hospitality, and other industries. Once you get identity theft protection and restoration service, an assigned representative can tackle cases of identity theft and fraud on your behalf. The $1 million in coverage can reimburse you for unauthorized transactions, legal fees, and other out-of-pocket expenses. Policies start around $75 for individual and $150 for families per year. Let's talk about long-term care insurance. Do you have parents or other loved ones who may need additional support in the future when they can no longer take care of themselves? It could be help with bathing, dressing, eating, standing up or sitting down, using the toilet, or addressing incontinence. It can be further complicated if there are memory issues affecting routines such as taking medications. Do your loved ones have the financial means to pay for additional support, or will it fall to you and possibly your siblings? Have you thought about who would help and support you when you need it and how much it could cost? Upon reaching the age of 65, there is a 71% chance an individual will need additional support later in life. The average cost of an assisted living facility is $108,000 per year or $9,000 per month. This does not include memory care or other support, and Medicare does not pay for long-term care. Let me say that again. Medicare does not pay for long-term care. The three ways to pay for this type of support include savings, insurance, and Medicaid, which is state-run support. To qualify for Medicaid, almost all assets must be spent down. A long-term care policy pays for custodial care, whether part-time or full-time support in the home or in a facility. It also pays for adult daycare, dementia care, and more. It covers care when the policyholder is unable to perform at least 2 of the 6 activities of daily living. Unless there is a family history of needing a policy earlier in life, the normal age to acquire a policy is between 55 and 59, and that's because premiums increase significantly at the age of 60. You get to choose the daily dollar amount of coverage, how many years of coverage, inflation protection, and more. And many policies now include a death benefit or life insurance as well. If you can, have an occasional discussion with your loved ones about what they want. You can discuss the usefulness of this policy and whether it is more affordable to pay the premiums or out of pocket for long-term care. They may instead choose you and your siblings for support. Besides the time, energy, and emotional equity you and your siblings may experience between parenting and caregiving, there's also a financial impact. AARP's Public Policy Institute reported that 37% of caregivers quit their jobs or reduced their work hours to care for someone age 50 and over. Job loss or reduced hours resulted in a loss of wages, health insurance and other job benefits, retirement savings or investment opportunities, and Social Security benefits, all of which mean unintended financial penalties for the perpetual caregiver. Speaking of life insurance, you only need it for those who depend on your income. If you are single and have no dependents, you do not need it. If you have group life insurance through your employer, you may be paying for a policy you do not need. The premiums you pay through work are based on your age and continue to increase as you get older. Wait until you're married or have a dependent before getting a policy. When you do need it, you can decide what the right amount is. If you get a term life policy worth 10 to 12 times your salary, your beneficiary can invest the money and replace your salary through annual withdrawals. Another common method is to get a term life policy to cover debt, income, mortgage, and education expenses. A term life policy is best because you only need it until dependents move out or you have become self-insured, meaning you have accumulated enough savings and assets to leave a legacy. Permanent life insurance is extremely expensive and is often touted as an investment tool. The insurance company invests your premiums, often guaranteeing a rate of return that is below what you could get when investing on your own. Eventually, it will build a cash value. If you do not use the cash value before you die, the cash value goes to the insurance company. The original death benefit goes to your beneficiary. Long-term disability is another one. It replaces a portion of your income when you're disabled for 6 months or longer. If you have a 6-month emergency fund, you can ride out the waiting period for this policy to take effect. When you get a policy, you can pay for it from your checking or savings account, which is after-tax dollars, because when you're funding the premiums with after-tax dollars, it ensures that the payout benefit from your policy will be tax-free. Once you retire, you will no longer need this policy. Professional liability insurance is another important type of policy to have while employed because it protects you from acts, errors, or omissions when there are civil, administrative, or criminal legal proceedings against you. Depending on your profession and responsibilities, a few $100s per year in coverage can offer you $1 million or more to pay for attorney's fees and other fees associated with the proceedings. Although the 3 providers listed here specialize in coverage for federal, military, law enforcement, and U.S. government contractors, you may have providers that cover your specific profession. In some cases, the employer may reimburse for the premiums each year. You can drop this policy in retirement as well. When it comes to enrollment, you may need to wait for open enrollment season for medical, vision, and dental insurance. Other times, you may have a qualifying life event, such as the addition or subtraction of a dependent or a relocation outside your current coverage area. With other types of insurance, you can enroll at any time. This includes auto, homeowners or renters, umbrella policy, term life insurance, identity theft protection and restoration, long-term disability insurance, professional liability insurance, and long-term care insurance. If you are considering enrolling in Medicare, you can get free, unbiased education and counseling from your home state by the State Health Insurance Assistance Program, or SHIP. You can find your state's program at shiphelp.org. If you would like a copy of the slides with links to the resources, go to https://tinyurl.com/talk-money-material. You'll find several tools and resources arranged in different folders by topic. Thanks so much for joining me, and keep learning, earning, and growing. You've got this.